Thank you, James. Towards the end of last year and earlier on this year, Standard Chartered and Marine Money, we did a survey of ship owners, ship managers, and charterers about some of their views for 2024. We asked them a series of questions. One of the questions was about what do you take into consideration when sort of making shipping investments. By far, the most common response was market prospects and the economic outlook. It wasn't decarbonization, it wasn't availability of finance, because presumably that's there for them. But they're very keen to look at where the market is and what are the operational difficulties. That's what we're going to be talking about now. We have a session which is called Canals, Wars, China and Trade Growth, the Real Shipping Challenges in 24. Our moderator is Simon Petch, partner of Watson, Farley and Williams. And let me just very quickly introduce the panel. We have Semiramis Assimakopolou, who's Senior Vice President of Sales at Signal Group. James Cirenza, Managing Director, DNB Markets. We have Tim Power, who's a Managing Director at Drewry. We have Alok Kumar, who's the Chairman of Alphard Group. And we have Ivar Myklebust, who's chair of the Board of Directors of Graham Car Carriers. And with that, Simon, over to you, please.
Thank you very much, Kevin. And thank you to Marine Money and to the panelists and to you all for joining us today. So we've got a fair amount of stuff we can talk about and get through. 2023 was an interesting year. Certainly in the legal world, we've seen a lot of challenges, a lot of sort of shifting of direction in terms of clarity in contracting. So counterparty risk no longer means just commercial risk. You've obviously got issues with ESG, you've got issues with sanctions and so forth. Different sector participants have different approaches to the way they do these things and different risk appetites, so that is a factor. And yes, just clarity generally in contracting terms. But our first issue to address is Canals. Obviously, mostly in the news is Suez and what's going on there. So my first question, which is to Ivar, so the first vessel was a car carrier that got affected by the Houthi issues there, the Galaxy Leader. Car carrier sector had been enjoying life to some extent until then. What's been the impact and how do you see that evolving?
Yeah, thank you. I think everyone has seen this Mission Impossible style video that was produced about the hijacking that vessel. Just to give you a little bit of backdrop, the car carrier, the specialized car carrier business really originates based on Asian exports, which takes about 60% of the total capacity in this sector. Half of it goes westwards and the rest goes eastwards across the Pacific, rough numbers. Here you see the Asian export volumes for the last 12, 13 years. As you've seen, they've been fairly stable until the COVID kicked in, but has seen a phenomenal rise in the years thereafter. And if you do the next slide, the drill down is really China, which has evolved from producing and exporting around about 1 million cars, predominantly to Asia and the Indian Ocean countries, to really kicking off and exporting a huge number of electrical vehicles, predominantly to Northern Europe and some of them to US. And that, of course, has had a significant impact on the trade balances and the trade volumes, and also of the volumes going through the canals. So the next slide emphasizes this point. These are the, on a monthly basis, these are the transits in the Suez Canal for car carriers from 2021 onwards. And the yellow line there is vessels going around the Cape of Good Hope. So 2021 saw on average 60 plus transits a month. 2022, 70-ish, 75 on average. 2023, close to 90 transits a month. And the day before yesterday, the 23rd, is the first day, single day, where there were no PCTs in the Red Sea, which hasn't been seen for the last 30 years, I think, 0. So that has a significant impact on the trade balance. Just some simple numbers here. If you do a round voyage basis for the Far East to Northern Europe or US East Coast, it takes about 10 to 12 days extra each way. Calculating this backwards into capacity, it ties up, if everything was to go around a good hope, it means 5 to 7% increase in demand for PCTCs. And when this comes on top of a situation where already the equivalent of maybe 10% of the carrying fleet is already carried in other sources like shipping containers, open hatch vessels, heavy lift vessels, etc., well, you have the recipe for a very tight and very strange market in the sense. So for this trade, the Suez Canal disruptions means basically higher freight costs, delayed deliveries to all customers, and a real increase in sort of overall uncertainty for how long is this going to last, and what are the more sort of medium to long-term impacts. Short term, it means that every responsible operator now reroutes their vessel around the Good Hope, to cut it short.
Thank you very much. I think we'll get on to the how long is this going to take. Tim, we were talking about container sector last week. Do you want to share some thoughts there?
Sure. And let's talk about containers. Similar situation in many respects to the car carrier story. If we go to the first slide, you'll see that the most apparent and obvious impact is sea freights soaring. So here's our rates showing Asia, North Europe, Asia Med, trebling or more than trebling since the start of this crisis. What is interesting, if we go to the next slide, is to see what is the possible effect on operating costs, because that's the other side of the equation if you're thinking about shipping line profitability. Lots of numbers on this slide, so I want to just draw your attention to scenario 1. If you go down to where it says total costs, you can see it says plus 2.7%. Now, how do you get to that plus 2.7%? That seems ridiculously low. Well, if you stay at the same speed, if you steam at around 13 knots, and you put 2 additional ships into your loop from Asia to North Europe, and you avoid the canal costs, actually the incremental cost is only around 3%. Surprising. Why does this matter? It is because, as those of you who follow this market know, container shipping is massively over tonnage now, for reasons that I have never quite understood. During the pandemic, everybody ordered every ship they could get their hands on. For MSC, it was obvious because they wanted to become independent of Maersk and to run their own independent service, so they needed more ships. But actually, I don't know quite why the rest of them did. Anyhow, they've got the ships. So if you put 2 extra ships in that loop, you're really coming out square in terms of costs, and your rates are 3 times or maybe more than they were. If you don't do that, however, if you speed up to maintain the transit time, then you can see you've got a 21% increase in cost. So how lines adapt to this situation is going to be really interesting. If we look at the bigger picture on the next slide, which is about what happens to supply and demand, on our introductory call, James gave me a great analogy. He says, you fall off the top of your hotel and you bounce off an awning. I'll let you just imagine that image for a second. This is what he says is what is effectively what's happening to container shipping now. The declines in rates from mid-2022 onwards were continuous and effectively back to the bad old days. How much difference will this make? Well, our guesstimate calculations, this could soak up 9% of capacity, which is good news for container shipping lines. But is it enough? Well, you can see our supply-demand projection. The yellow line is the effect of this Suez crisis. And you can see that it improves the supply-demand balance, but by no means enough to get the market back into equilibrium. So my guess, although this is not the official Drewry view, is that once all these new loops are established, and assuming this situation continues, which it probably will, actually rates will start to erode. There'll be enough to cover the incremental costs of doing this new routing, but they're not going to save the industry.
Thank you. And now I'm going to call on Semi to talk about tankers and dry bulk, and dry bulk, I guess, quite neatly segues also into wars in the sense of the disruptions coming out of the Black Sea.
So we saw already that containers have almost all rerouted. So how the picture looks like for tankers and dry bulk, if you see on the top two graphs, what we see here is the percentage of voyages that cross Suez compared to the total number of voyages that happen in 2023. So we did that in order to understand which segment will probably have the biggest impact. And if you see here, Suezmax, for example, they represent about 20% of 20% of the voyages cross through the Suez Canal. No wonder the name. And after doing this graph, I drilled down a little bit further on Aframax's class LR2s, and LR2s is also one of the segments that is really involved with the Suez Canal. So if you have to choose between tankers and dry, I think tankers will be the segment that will see the most impact, and I would focus more on Suez, Afras, Panamaxes, and LR2s, because those are the trades that are more relevant for Suez crossing. If you look at Suezmaxes, typically the voyages that go through the Suez Canal are Russia to India and Arabian Gulf to the Med. So it's really much longer if you have to go through the Cape of Good Hope in the order of ×3, the duration of the voyage. And of course that will have implications on freight cost, as it was said by the panel here, as well as CIIs and emissions. A lot of these voyages touch Europe, therefore EU ETS is part of the equation. And if you look at the CIIs, it will definitely have an impact since you transport the same quantities, but you have like 3 times the ballast legs compared to before. So at the end of the day, it will be higher freight cost in the order of magnitude. For example, for Russia to India, in order to get exactly the same TC is almost $4 million more dollars in terms of freight cost. And the question is like, can you change these flows and get the same commodities from elsewhere? But that's something that cannot change overnight. So you have contracts in place, the refineries take a specific type of crude. So the question is like, will you have changes in trading patterns, or will there be higher transportation cost and therefore higher cost for the goods overall? So that's in terms of tankers. And if you look, the question is like, how long will it last? If it lasts more than a couple of months, then, for example, for Suezmaxes, at the bottom right graph, if 100% of the vessels reroute, this can have an impact on oversupply in the order of 30%. And that's a lot. But if you look at dry, for example, it won't have a significant impact, and the market is already quite oversupplied in terms of vessels. So you wouldn't see that impact there. That's the main focus, I think, on the tankers market.
Thank you. And we have been dwelling slightly on Suez. Panama, obviously, there's been issues there, more prolonged. The drought has affected the lakes and therefore the ease of transit. Captain Alok, could I get you to comment on what we've heard so far, and perhaps a bit about Panama as well?
Let me talk more on the Suez side, especially in the dry bulk sector. The calculation what he was showing on percentage on the reduced speed. For a Kamsarmax doing US to India, East Coast and West Coast, you will be surprised to know that the freight difference is only about $2, reducing the cost for Suez Canal transit. So saying freight for $38, the price difference is only $2, but 10 to 12 days of additional sailing. So I don't think for a charter or shipper it's going to impact a lot on the monetary terms. However, ton mile days increases, but as he said, oversupply on the dry bulk is already there, and market is also not very high. So overall, not much impact on the dry bulk sector on this. However, this scenario, how long it's going to stay, even if the problem is solved on this side, but normally a problem to come in and people take action very, very quickly. But even if it is sorted out for a seafarer and the ship owner, manager to get convinced that it is safe to transit, it will still continue for 6 months more once you say everything is okay. So this is going to continue even if the problem is solved. Thank you.
Thank you very much. Jim, as the panel's resident banker, could you give us your thoughts from an investment/finance perspective?
I had a meeting on Friday with one of the biggest US long-only shipping investors, and the conclusion at the end of an hour was that I'm not allowed to take a 3-month view, so containers are off the table. He liked my analogy of falling off a hotel and landing on an awning. We're not done falling. After this storm, we've only gotten back to 80, 82% utilization. That's not pricing power. Car carriers are different, but the conversation focused around the sectors where the order book is tighter, and even though the sectors seem to be less affected, they aren't necessarily less affected. So even though dry bulk, for instance, when you get to the mid-sized ships, I had dinner last night with an analyst in the dry bulk space. He said, our ships can't make it around Africa without refueling. He says, we have no chance in getting there in 2 weeks. We've actually waited 2 weeks to refuel going around the Cape because there isn't enough fuel for all the additional traffic going around at this point. So tankers is getting a lot of attention. Chemical tankers are getting a lot of attention. Car carriers is a smaller segment, but that's worked out really well. And even dry bulk, with only 6% of the fleet affected theoretically, when you add the additional time, it's a much bigger impact. And so that's where investors have paid attention, because they're looking for things that don't just get worse because the order book is going to drown out, the benefits of what we've seen in containers. This disruption has only taken last year's supply of ships off the table. It hasn't taken this year or next year's supply of ships off the table. So if you've got a 1-year, 3-year view, you're still focused on those segments where the order book is tight.
Thanks. And I guess when we're looking at bringing in China here, we heard this morning about downturn in China, but I think we're distinguishing between different parts of China. So the consumer in China is not so confident, but maybe other areas.
I mean, real quickly, I'm a big fan of China Beige Book. And I think China Beige Book does a better job than any bulge bracket firm in terms of their strategy work on China. They do surveys every month. They do thousands of surveys every month with small and medium-sized businesses. The consumer is not a good story, but the manufacturing sector has held up really well. The lending to the manufacturing sector, particularly related to commodities, has actually been picking up. And so the dry bulk story as it relates to China wasn't a bad story last year. It was certainly a good fourth quarter. It's hard to poke any holes in it right now.
Thanks very much. And then coming back for you in reverse order, so Captain Alok, China, how do you see that panning out in 2024?
First of all, how much can we rely on the data from the China, reliability factor itself, this. Growth-wise, 24 is going to be lesser than 23. They are saying less than 5%. But there, in reality, you see a lot of Chinese interest in buying capes, and especially on the older tonnage, which is between 15 to 20 year. So one side prediction is that economy is not doing good, less import, but when you see Chinese people coming and buying aggressively on the, lot of inquiry from the brokers on, especially on the capes. So maybe near future, within a year or two, they must be seeing something which we are not seeing it. This is what happened in 2021 when, normally people were distressed situation, what's going to happen dry bulk. But you see a lot of Chinese people started buying ships in 2021, market went up. So economy-wise, not showing very good scene, but looking at Chinese showing interest in Cape can be a turning point here. Thank you.
Thank you. And then Semi, China?
China, I think the interesting part there is more linked with the Russia and Ukraine situation. So you had you have the war situation there, and if you look at the three places, Russia, Ukraine, and Israel, Israel typically represents a small percent of the global commodities. So Ukraine, what is interesting is that the production and exports in December and January, especially to China, have increased a lot, not to pre-war levels, but almost double compared to a couple of months before. Therefore, this flow is established again, and primarily it goes to the Far East and China. But it's also Suez relevant. So that's interesting to see how this will play out.
And Tim, China.
Well, a couple of things. I don't know whether I'm jumping into a later topic, but obviously we have the prospect of Donald Trump coming back to the White House. Just wanted to go back to what happened in the last China-US trade war. And everybody talking about decoupling and everything. Well, to some extent, but actually, if you look at what actually happened, China did indeed lose significant share of the Asia-US trade, has gone down from about 70% of that trade in containers to about 60%. But that doesn't mean to say it's all gone back to the US, far from it. If you look at Southeast Asia, Vietnam in particular has picked up a lot of that volume. So actually, it's just a shift in geography as far as shipping is concerned. It's not a fundamental shift. And our view, which maybe we'll come back to later, is that deglobalization is a much overused term. Another thing which is much more anecdotal is our experience looking at how ports are developing in China and the use of technology. I was at a conference in Ningbo in the middle of last year talking to a German process engineer, and he was saying to me, he buys cranes for APM terminals, and he was saying, 10 years ago, we Germans were way ahead of the Chinese in this technology. Now they are way ahead of us. The first truly zero carbon container terminal in the world, I believe, is in Tianjin. And they've just, decarbonization in China, when I previously went to conferences there, it was a tiny item on the agenda. Now it is really happening in real life. So I think high-tech China is real. And I think that's, as Sarah was talking about, high-quality growth, I think that is coming. And we really mustn't underestimate the ability of China to do high-tech. It's not a question of the old paradigm of, oh, well, they can just copy what we're doing. I don't believe that anymore. And I think the numbers you saw on the EV that Ivar showed are demonstrating that.
Thank you. And then, Ivar, China thoughts?
Yeah, and coming back to the car sector, the Chinese have the largest and clearly the most modern production apparatus in the world. They have production capacity equivalent to around 35, maybe even 40% of total global production. The Japanese have long stopped worrying about European companies as their main competitors, but they have been focusing hard on China for a number of years. And Tim mentioned Donald Trump. It's a small but interesting fun fact that the import ratio of cars actually increased to the US during Trump's previous presidency. And not many Americans know that every single Buick sold in the US is produced in China. About 2/3 of all Chevrolets are produced in China. And all Tesla models except the S and the X are produced in China. So the Chinese are, I agree with Tim, I mean, the high-tech production capacity across the board in many sectors is growing really fast, and the lasting impact on trade and trade lanes and trade lane adjustments, I think, is what we're seeing is just the beginning, I think.
Thank you. Now, our remit does include war, so I'm going to ask Semi just to make a comment on that, but please do, the rest of the panelists, feel free to jump in. I think by war, we're predominantly talking about Ukraine, aren't we?
Yeah, so as said earlier, I think when you look at war, the main areas that have impact on shipping is Ukraine and Russia. Israel is still a small percent. So on Ukraine, the interesting thing is the increase on exports. In Russia, though, I think the focus is still the dark fleet. So, and the dark fleet is often defined in different ways. So the way I think somebody can understand easily, the dark fleet is basically vessels that are relatively old, that switch on and off AIS, that are run typically by single ship companies, do not have approvals. So that's a market of vessels that is currently participating in this trade, while theoretically under normal circumstances they shouldn't be there. So in a way the dark fleet is not the darker, it's basically taking a part of the supply of cargoes that normally would be run under other vessels. So I think that's, while shipping in general profits of bad situations and wars, and that's quite sad, but the Russian situation has created premium for this type of trade. But in longer term, basically, it helps on the oversupply problem, because these vessels normally they should have been gone for scrape, while now they participate on a trade that is not that is a trade that exists before. It's not that Russia suddenly produces a lot more oil and therefore this is a separate market altogether. It's the same more or less quantities taken by a number of vessels that normally shouldn't be there. So I think that's an interesting part in terms of the war situation in Russia on the tanker side.
Thank you. I mean, that is an interesting point, that the dark fleet, does it exist, does it not exist, or the grey fleets, and how that impacts. Just giving anyone else a chance to jump in before next question. War and dark fleet, or war leading into
one war thing I think is maybe hasn't been mentioned yet, but is the effect on Egypt of the loss of Suez Canal revenue. The Egyptians financed the expansion of that canal with a lot of, I think, issuing bonds to the public. And if people don't get their money back, that's going to be a huge risk for Egypt. So I would expect that somehow they will be saying to the Houthis, could you please stop doing this? Because actually you're going to kill our economy. So I think this is a really key point.
A good point, yes, yes. Now, I'm conscious we're drawing towards the end. We might have a couple of minutes and questions, but before we do, I do want to jump on the Trump bandwagon and ask that question. So Tim, Ivar already mentioned it, so let's go to Jim. So potentially staring down the barrel of a new Trump presidency and all the excitement that has to offer, and tying that in with globalization generally, some thoughts there.
Let's not get carried away. There's still 10 months. That's an eternity in Washington, D.C. It all comes down to 7 or 8 states. We already know the outcome in 42 or 43 states already. And statistically, it's not clear how a Trump-Biden election plays out, because again, the margin of in those 7 or 8 states is too narrow to say it's significant at this point. That aside, I think we've seen both playbooks. So if Trump's in, you would expect us to increase the U.S. supply of oil. You would expect an increase in associated gases as well, and you would expect to see trade wars again. Yeah, and I'm not going to go to whether peace breaks out, which I think is the biggest risk to shipping, period. And if Biden gets in, I think we've seen that. I think we've seen that playbook. I think our oil production plateaus where it is, and the status quo. But the additional oil and associated gases that would come with the Trump would bring a couple other sectors, not well represented up here, but bring a couple other sectors back into an interesting discussion.
Thank you. Captain Alok, positive, negative, or indifferent to a Trump president?
He's very unpredictable, so you do not know how it turns out to be.
Thank you. And Semi?
No comment.
Thanks very much. Tim, Ivar, anything more to add on deglobalization generally?
No, I mean, our economist touched upon it in the introductory comments about the level of interest rates, how long they're going to stay at these levels, how fast will they come down, etc. It's clear that for a capital-intensive business like shipping, that makes a lot of difference, and it has had, I think, clearly a dampening effect on the order books. So the tighter availability of berths at quality shipyard has moved pricing power more into their camp, particularly in payment terms. You've seen a lot of changes over the last 24 months. And it's a huge difference ordering something which costs $100 million if you're paying 4 times 5 and 80% on delivery at 2% interest rates, and the $100 million if you're paying 3 times 20 and 40% on delivery at 8% interest rate. That's a huge difference in capex. So, so the sort of the inflationary activities of whatever presidency in the US we'll see in about a year or so is going to have a pretty long-lasting impact on this sector, I think.
Oh yes, and we should probably reiterate, it isn't just the US, it's a large portion of the world's democratic population going to the polls this year, so impacts there as well. Tim, any last thought? You've already mentioned it.
Just back to the question of China and deglobalization. We were looking at this on behalf of a large Asian conglomerate, and we came across some very interesting work done by BCG where they looked at the nature of supply chains, and what they saw was that multi-step supply chains are much more common than single-step. So even if we think that China is less involved in direct trade, actually it'll be much more involved in indirect trade. So the mutual dependence between China and the rest of the world economically is now deeply embedded, and that of course has very profound economic implications, but also political implications. And one terrifying number I read in The Spectator a few days ago was that if there were a China invasion of Taiwan, it would cause a contraction of 10% in world GDP, which would be an unimaginable catastrophe and worse than the First World War. So let's hope it doesn't happen.
Thank you. On that cheery note, we've run out of time. And Kevin said no time for questions, so if you do have a question, please come and talk to us afterwards. Just leaves it to me to thank the panel very much and say good morning.